Second is the National Futures Association. The National Futures Association is a membership body and the sole membership body for all of the futures professionals, whether they're clearing firms, brokerage firms, or brokers themselves. Everyone is a member of the National Futures Association, and the NFA steps in to settle grievances among the members themselves, as well as to help individual investors protect themselves from members of the exchange, of the National Futures Association. Now, how futures operates today. In no way are futures investment lightweights, but by all industry standards, all the attention is paid to stocks. But what's unique is more money is actually traded on the futures and commodities exchanges. For instance, daily trade in Chicago runs into the billions of dollars. Some numbers have estimated anywhere from $5 to $7 billion a day easily are traded in the Chicago Mercantile Exchange and the Chicago Board of Trade. And this doesn't even account for many of the other trade exchanges that are not in Chicago, such as the New York Mercantile Exchange or the New York Futures Exchange. So many of these exchanges trade in the billions of dollars. So a lot of liquidity is available in these markets. Eurex, which is the premier futures trading exchange for Europe, actually trades 40% times higher than the largest Chicago exchange, which is the Chicago Mercantile Exchange. So there's a lot of money floating around in futures. At particular estimates, in a given month, the numbers run into the trillions of dollars. And how this works is futures themselves are not, the futures contracts themselves are not actually being delivered on. They just create liquidity for the end products. And so there may be more contracts at any given time than actual goods available. Oftentimes I hear news reports and bulletins about people who invest in silver futures. And they like to say, well, future silver contracts total 10 times or 20 times more than the actual goods and supplies that silver exists. So silver should shoot through the roof. Well, this is why futures exist in the first place, to find price discovery. So of course there's always going to be more futures contracts than the actual goods that are being delivered. It's very unique to futures. Now there are two categories of futures that we'll get into: traditional commodities and financial instruments. Many of you who may have invested in futures in the early 70s or in the 60s only knew of futures as one way, and that was as commodities. At that time, only soybeans and grains were traded. Now, many other instruments are traded. In fact, 70% of most instruments traded are financial instruments. And so the word commodities and futures are actually used interchangeably now in most vernacular. Traditional commodities tend to be corn, soybean, milk, frozen concentrated orange juice, coffee, sugar, cocoa. Many of the things you most likely had for breakfast this morning are going to eat this evening for dinner. So traditional commodities typically deal with the agriculture. Today, that's about 25 to 30% of all futures contracts. Actually, the majority of futures contracts deal with financial instruments. And much of this turnover happened in the 1970s when gold was finally allowed to be off the gold peg and currencies were introduced into the marketplace. Many financial instruments that are traded today involve interest rates, such as the Treasury bond, the T-bill. Many of you with mortgages are familiar with the LIBOR. That's also traded as a futures contract. The euro dollar, which are actually dollars, U.S. dollars that sit in foreign banks, which are traded on an interest rate basis. Stock indices, the NASDAQ 100 is traded as a futures contract. One of the things I tell people when they talk about the dot-com bubble burst, and they explain to me that much of their investments were, retirement funds were hurt by that, I oftentimes feel terribly bad because a lot of them could have averted that had they known about hedging themselves or protecting themselves with the NASDAQ 100 futures contracts. Also, there's the S&P 500, which is highly popular, the mini S&P 500. The Dow Jones is traded. So every major indices, as well as the Nikkei exchange in Japan, is traded as a futures contract. Currencies, every major currency is traded. The U.S. dollar is traded in a dollar index format. You have the Japanese yen, the Canadian dollar, the Australian dollar. So many currencies are traded, if not all of them. Precious metals, we've talked about that, silver, gold, but also non-precious metals. Copper is a very popular contract, as well as aluminum. And lastly, individual stocks have been recently introduced, so you can now trade GE and eBay as futures contracts. Now, currently futures trade in a particular order of importance, and not to say that any one is better than the other, is just that there's more liquidity. The top contracts which have the most liquidity are the interest rate contracts. The Treasury bonds and the T-bills tend to be very highly traded by financial institutions, banks, and so it's very liquid. One of the top liquid interest rate contracts in the world is the euro-dollar contract, and with that liquidity also brings great volatility. Second, petroleum products. Everything from the gasoline that goes in your car to the barrels of oil that are traded on the open exchange. Natural gas is traded, as well as heating oil. All these contracts are traded, and they're the second top traded contracts of the futures markets. Third are stock indexes, which we've already talked about, the S&Ps and the Dow Jones. Fourth are the currencies. Fifth, precious metals. And in I guess a state of irony, the agricultural contracts, which actually set the stage for futures, are traded last. Most people don't invest in the traditional commodities, but that doesn't mean they don't have liquidity. There's a lot of money to be made still in trading soybean and corn. Who are the players in futures investing? This is very interesting. With stock investing, you have many different people coming in and out of the market, whether they be individual investors, pension funds, operators. Many people come in and invest. In futures, there are really only two types of people, and neither of them are actually investors. The first are the hedgers. These are people who are buying or selling the products, and they come to futures solely for the insurance aspect of it. They want to be able to lock in the price of the goods today for delivery later, or they're trying to cover their costs. They're trying to lock in the prices to make sure that they can pay their bills. So they come to futures solely to protect themselves. And the second group of people are the speculators, and that's you and me. The speculators come in to take advantage of the price changes. And as speculators, there are two types. There are the large speculators who come in with millions of dollars to trade, and then there are the small speculators. The CFTC, the Commodity Futures Trading Commission, sets the standard of who is a large speculator and who is a small speculator. And this is typically based on the number of contracts held. Larger speculators will hold contracts, depending on the markets, of anywhere from 50 to 100 to maybe several hundred contracts at a time. Small speculators tend to trade contracts of 25 or less, typically no more than 10 actually. So we tend to fall into the small speculator range. Now, let's explain exactly who the hedgers are. Hedgers typically tend to be bankers, mutual funds, pension portfolios, currency dealers, brokerage houses, agricultural industry, agribusiness, who include retailers such as any company like Burger King or McDonald's, retailers who actually need to take delivery and need to lock in prices for promotions months in advance, or processors who need to process the food and package them, such as cereal companies and potato chip factories. Now, the function of futures for hedgers is as an insurance policy. Number one, they use futures to protect their bottom line so that they can get loans and price out their expenses for the rest of the year.